Hello, Maverick traders. Welcome out to your option foundations. And today we're going to look at 5 types of volatility. So, when we say volatility, volatility meaning, things that can create movement in stock, right? So when you think of volatility, there's low periods of volatility, very little wiggle in an asset. There's high periods of volatility. And we're going to look at what drives that. And there's different things that drive that volatility, different reactions to it, and so on. So with that, let's jump in. As always, let me remind you that everything we go through here is intended to be educational and instructive as you build out your trading plan. And hopefully these concepts help you to do that. So what is volatility? Well, in the markets, volatility is often associated with big swings in either direction, right? When stocks rise and fall a large amount, more than 1% a day, it might be considered a very volatile market. Volatility can be measured through statistics. So you could say, well, here's the standard deviation of its normal move, right? And if it moves outside of the norm, if it comes out here to 2 and 3 standard deviations, either because the stock price is super low, huge volatile move down, or a big volatile reaction to the upside, that would be statistically outside of the expected move, or in essence, the stock is more volatile, more bullish volatility, more bearish volatility than expected. So you could use it in that context of, how does this compare to statistics? So this is kind of the normal approach. When you say something is volatile, people think, okay, it's moving a lot. It has bigger reactions and it has, wider swings and that sort of concept. But in reality, we can kind of break this down and say, well, volatility is not good or bad. We just want to understand it. We want to know what's likely, right? There will be periods of high volatility or low volatility. It's important as a trader to recognize that because the strategy that you select will have a lot to do in the options market with volatility. For example, would you want to be trading some butterfly? A butterfly risk graph looks like this, where you make money if the stock, here's your zero line where you break even. You make money if it's anywhere in this area, right? It could be a little higher, a little lower, but anything outside of that, too high or too low, is a losing trade. So what would we like in terms of a butterfly? Well, we would like for the stock to finish inside of this butterfly zone. So we want, it's kind of a trade that would bet on volatility dying down once it's in this zone. We can position the butterfly any price level we want, but once it's inside there, what do you want to have happen? You want the volatility to die down. You want it to get sticky around these price levels and kind of finish there at expiration. Well, that's an example of kind of a trade that would bet on at least once it's in your butterfly for volatility to decrease. That would be ideal. On the flip side of that, you have risk graphs that sometimes look like this, where again, here's the zero line. And what is this type of risk graph? Well, it's the type of risk graph that can keep making money if the stock explodes to the downside or explodes to the upside. But if it stays sideways in this range, then you've got a problem. So this would be like a long straddle trade where you buy both the call and the put. You literally don't care which way it goes. What do you want? Big volatility. I don't care if it's a big volatility event that causes the stock to drop. I don't care if it's a big volatility event that causes the stock to rise, but I need volatility in order for this trade to pan out. So there are option trades, in other words, in the market that have a lot to do with volatility. So understanding how fundamentals can drive it, understanding how just the stocks move can drive volatility, understanding the difference between its historical versus its implied. Those are 2 different types of volatility. And then finally, even just market volatility. How does the underlying market impact my asset and drive that? So let's dig into each one. One that we might look at first is fundamental volatility. So this is how the everyday things within a company impact volatility. So think about it. Seasonality. Different companies have different seasonal patterns. And so if you're trading an energy stock or you're trading a ski resort or you're trading, there's different periods that have different seasonal patterns. For example, you have to understand that if you're trading a ski resort, their ski season is open from November. I think ski season actually starts, while we're on that subject, tomorrow. November 20th is the opening of ski season here. And then it will go until sometimes well into the spring, even into the summer if there's still snowfall. But that's the season, right? And so they have a dead period in the summer months. Well, that will impact the stock because of just seasonality, the earnings, the expected profitability, how they get through that period, what the, what the results have been and what investors are expecting during the off season. Gas prices, well, those have different periods where people travel a lot or travel a little, right? And so gas prices have seasonal patterns where they tend to rise in that May to August period as people are traveling more as you get into those summer months. And when you're in the, winter season, there's less travel. People are less inclined to go out in the snow and in the rain and all that, where it's really bad conditions. They're going to try to drive less. And so those are ideas of seasonality. Even the stock market itself will have different seasonal patterns. For example, September, October tend to be the worst months for the market. Why is that? Well, you can make a lot of different suggestions for why it is. Why have most of the market crashes occurred in kind of this fall period, this September to October time period? If you look back at the financial crisis that we experienced in 2008, that was the worst period of time. If you look back to 1987, Black Monday, when the market fell 20% in a day, well, it happened in that period of time. So just for whatever reason, that tends to be a weaker period. Or you've heard other seasonality ideas where traders say, the old investing philosophy, sell in May and go away. The idea that most of the stock market returns are made from October 31st, from Halloween. So you reinvest after you get past October, and then you stay invested until May, and you sell in May. So at May 1st, that time period, you want to be getting out. And if you had owned the stock market just from October 31st through May and avoided this whole period from May 1st to October 31st, you'd have done better. Your drawdowns would have been much lower, et cetera, et cetera. So it's just a seasonal pattern. Do any of these things guarantee what's going to happen in the future? No, but it is a driver for volatility, and it is a driver for, where people might get nervous. And they might say, well, if I'm, looking at trading the markets, I want to be aware of this seasonal pattern. So that's one fundamental concept. The weather can be fundamentally impactful for different companies or for the markets. When you think about, any company that works in agriculture, if you're trading Archer Daniels Midland or John Deere or any of these, it could be impacted based on the supply and demand of weather, right? Whether that's favorable or not, blizzards and droughts and all these sorts of things. It could also be impactful for insurance companies. That would be a derivative of this. Insurance companies, a lot of these farmers and different companies that produce this buy insurance just in case, right? They buy protection. So if it were really bad, or imagine tornadoes or hurricanes or all these sorts of things, any type of weather situation can not only be impactful for a company specifically, but definitely for insurance companies as well. So we've seen that when hurricanes have been really bad, you saw big insurance companies take billions of dollars in losses for that period of time. So weather is a factor of volatility for certain assets. In addition, world events, right? We can't control world events and unexpected events. I teach this concept of There are knowns and there are unknowns. And sometimes you have a known unknown, and sometimes you have an unknown unknown, and all these sorts of things. And what does that mean? Well, known unknowns we have all the time. This is the most common. For example, we know that this morning, every Thursday morning, they're going to come out with initial jobless claims. This is new people claiming to be jobless. We know it's coming. We know the date. We know the time. But there is an unknown, which is, well, what's the number going to be and how is the market going to react to that? On occasion, you'll get unknown unknowns. And this is where the markets tend to move the most. This is a much bigger driver of volatility than a known unknown. This one, the markets were prepared for. But what's an example of an unknown unknown? An unknown unknown is something that's not on anyone's calendar. Nobody's ready. Nobody's expecting it. And then it brings up all the questions of, well, what does this do? How does that impact the markets, or markets pricing that in? And so it's far less likely that markets are pricing in an unknown unknown. This is when the market gets hit upside the head with an unknown unknown. That's where you see the biggest moves in volatility. So here we have an example, okay? You'll remember this oil supply that was blown up in Saudi Arabia. This happened in 2019, last year. 5% of global oil supply destroyed. When that happened, they're all, well, first of all, it's an unknown unknown, okay? Nobody was expecting it. Nobody knew that was about to happen. And then it brings up all the questions of, well, if 5% of supply just got destroyed, are we going to have enough oil in the short term to cover all the people that need it? And so what do you think short-term oil futures did? They spiked up because everybody said, well, we need oil and there might not be enough of it. So in the short term, oil futures spiked. Why didn't long-term oil futures spike though? Because everyone said, well, look, a year from now, we'll have plenty of oil. Everyone can increase supply. It's not a problem long term. This is a problem short term. So short term oil prices, oil futures spiked dramatically. Long term stayed relatively flat. This was an unknown unknown, and oil prices went crazy on it. What about COVID? We've been dealing with COVID. That's a perfect example of an unknown unknown. This was not on anyone's calendar and expected to occur. And when it started to play out, there were all the unknowns, and you saw the volatility that was caused by that. So ask yourself, when there is a major news event, is it an unknown unknown? I would put in that category not the presidential election. That's a known unknown. We knew it was coming, what date the election, all of that. We just didn't know how it was going to play out. That's a known unknown, not a huge reaction. The vaccine news is somewhat of an unknown unknown because we didn't know when they were going to come out and release the news, and we didn't know how good or bad or indifferent, that news would be. And it's beat expectations. So we didn't have it on any calendar. Sure, we knew it was coming, but we didn't know when, and it came out. We didn't know what the numbers would be. Well, Pfizer and Moderna, they're talking about effectiveness of this vaccine being at 90+%. That's fantastic. Those are numbers that kind of eradicate the disease. We weren't sure whether we were going to have to deal with this for years and years. Well, this is kind of like polio and those where you can take a vaccine and kind of eradicate this problem, which is very, very, strong data. And that's why markets really took off. And I think we'll probably, we'll ask ourselves, is it fully priced in? But it was kind of an unknown unknown and better numbers than expected. So it should create a little more positive reaction. It probably isn't fully priced in right out of the gates. So looking at this, let's move to the next type of volatility and talk about just stock price volatility, how different stocks can have impact on others. For example, due to computerized trading, algorithms, and things like that, there's invisible strings happening in the market, right? And there could be an effect on a stock you own that seems unrelated to the world around you. What happens to other stocks, especially if they're like the one you're interested in, can cause a rise or fall in volatility. So, in other words, just stock market volatility in general can create more volatility to follow. I would give as an example of this, just think about if, how stocks kind of trade in sympathy when they come out with this vaccine news, most of the healthcare stocks kind of trade with, it was funny if you look at when Pfizer announced the news that they had this vaccine, Pfizer hasn't traded as well as some of the other healthcare companies. Or if you just look at kind of algorithmic trading, if they're coming after tech overall and they're just buying it or selling it, most of tech is going to participate in that because they don't really care whether the symbol is Apple, Amazon, Google. They're just kind of buying the group that trades as a group. Same thing happens in energy. If they're coming after energy for better or worse, it doesn't matter if your symbol is Chevron or Exxon or Conoco, you're probably trading very similar. So there's just that combination. Now, this is very true when there's news, right? And so you have to think about the interrelationships of various companies because when a company like Boeing comes out and they had a second crash and the 737 MAX is all of a sudden in focus and there's talk about that there's flaws within the system, it's not just Boeing that's impacted. That's the first level. That's kind of where everybody knows that company is impacted. But there's a lot of other companies that deal with Boeing on a day-to-day level. Large contractors, people that make a lot of their profits based on the profitability of the 737. So a company like Spirit Aerosystems, well, it tanked right along with Boeing, in lockstep. Because if the 737 is going offline, well, that's going to impact their revenues, their earnings, their profitability. So an entire industry group could be impacted by the news of one, especially if there are connections between, those companies. We definitely saw that in the financial crisis. These correlations, you have to understand that correlations tend to rise in periods of volatility. So when stocks are moving dramatically to the upside or dramatically to the downside, that's when it almost doesn't matter about your symbol. It just matters what group you're in. Okay. If it's just a ho hum normal market, well, then it matters about your symbol, right? You'll trade a little better, a little worse. But look at the financial crisis in '08. It didn't matter what your symbol was. If you were a financial stock, everybody said, well, I don't know. Your company might be okay, but you have exposure to Lehman Brothers and Bear Stearns. You have potential risks. You have, inner workings with them. So we're not sure if we can trust you. So the entire financial sector was just plummeting to the downside, right? And you'll see that especially in periods of volatility where those correlations of industry groups really dramatically increase and they start to trade like a basket in periods of high volatility. Whether they're going up or down, they tend to trade much more like a basket of stocks. So historical volatility. This is your normal everyday reading of volatility in the asset. And it can be measured down to the exact number. As it suggests, it's the historical volatility of how much an asset has moved over the past 12 months. If the price varied very widely, well, it's more volatile. It'll have a high volatility reading. If it moved very little and it's considered kind of a lower risk, it will have a very low volatility reading. But this is the true kind of number to it. So when you pull up an option chain, and let me just show you live. Here's Beyond Meat. And if you just look at this, it had, when we pulled this, historical volatility was 106%. It was just flying all over the place. That tells you that this is highly, highly volatile, a very high percentage number. To put that into context, you'd probably want to compare to something like the S&P or something along those lines. So if I pull up an option chain, and we'll just go live right now, and I pull up SPY, which is the S&P 500 tracking stock, the S&P ETF, it'll give us a read on the market as a whole. And what do we see? Historical volatility at 22%. So to put that into context, Beyond Meat at 100% is considered 5 times as volatile than the market in general, right? So it's historical. That's how much it has moved. And every stock will have a different number because they're all different. They're all their own animal. SPY trades differently than something else. And so we could put in, let's look at gold prices. Well, GLD tracks gold prices spot for spot. Gold is less volatile than stocks, or at least it has been. 17% volatility. Okay, that's its historical. So it has had a lower volatility number. But then if you dig within stocks and you say, okay, well, within those asset classes, of course, gold has had less volatility. But within stocks, there are some stocks that are very high or some stocks that are very low volatility. If we look at something like Verizon will typically have kind of a lower volatility number, okay? Verizon's at 20% historical. If we were to compare that to some high flyer like Zoom or something, okay? Here's Zoom Video, and look at its historical volatility at 81%. So it's 4 times as volatile as the market, 4 times as volatile as Verizon, and so forth. Verizon has a little less volatility to stocks. Gold prices have had a little less volatility to stocks, to the S&P 500 anyway, and so on. So we can compare and contrast, and just with a quick look, we can actually kind of identify how volatile something has been. So that literally just gives us a reading. Okay, here's where it's at, here's how volatile it's been, and here's kind of what to expect out of that. So with that in mind, let me jump back here to our tools, and let's talk about implied volatility. Now, this is a little different. Implied, that word right there tells you something. It's what the market expects. It's implying that it should be this volatile in the future. Implied volatility is not, well, it's kind of based on historical. They're taking that into account, but it won't be the same number because the implied is the forward expectation. And this number comes from how the options are currently priced. Now, we can have periods where the implied is higher than historical. We also have periods where the implied is lower than historical. And it just varies from market to market, right? It varies from time to time. Sometimes, an asset class is expected to be more volatile than its history, and sometimes it's expected to be less. Well, we've gone through a fairly volatile period in stocks. So what you'll notice when we look at the implied is the implied can be a lot lower. So this is kind of that future look. This is saying, okay, given the knowledge that we have of all the major events upcoming, right? Here's all the big events. Well, we've got the vaccine, and we just passed the presidential election, and then we've got the inauguration, and we got this, and we got that. So the markets are forward looking, and they're pricing in all of the known, not the unknown, because who knows what those are, right? But anything known is priced in. And so they say, okay, here's what we're expecting. Here's our implied expectation for the future. Now, you can do a comparison and say, well, how does that look compared to history and my analysis? If the volatility seems underpriced, then you'd want to be more of a volatility or an option buyer. If the volatility appears to be overpriced, the implied anyway, that's the current pricing, If it seems like it's overpriced, you might look at selling or more neutral strategies, right? So you're making a judgment, an analysis as a trader to say, how do I think implied matches up with what I think the future is going to hold? And so when you do that, you can see here with Beyond Meat, it had historical volatility of 106, but the implied was only 54. So they were expecting, the options were priced for the future for that asset to be much, 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 much less volatile, half as volatile as what it had been previously. You see that? And so now this is what it's currently priced at. The options are pricing in 54% annualized volatility. Your job as a trader is to say, do I think that's too high or too low? What do I think? What are the strategies that are going to make most sense given how options are currently priced? So again, if we come back to that option chain and we look at something like Zoom, Zoom has historical volatility to the tune of 81%, but see its implied is at 90. So the options are pricing in even more volatility than what it has experienced. Your job as a trader is to say, well, do I agree? Do I disagree? Do I have no opinion? If I have no opinion on that, well, I don't trade on based on the volatility. But what do I expect? And what does the chart look like? Does it look like it's going to have more or less volatility? What do I think about the company's fundamentals? Do I think it's going to have more or less volatility than it's recently had? The options in this case, just as a comparison, doesn't mean they're overpriced, right? That 90% might be spot on. In fact, it might be underpriced. What if the stock goes crazy and has 100% realized volatility? Well, then looking back, these were underpriced. But just at a glance, we can clearly see that they're priced more expensive than what has been realized in the past. They're implying that there should be 90% volatility moving forward, and it's only had 81% in the past. If we do a comparison, let's go back to gold or something, okay? Notice that with gold, it's different. The implied is lower than historical. So with Zoom, they're expecting more volatility. They're actually expecting, or options are priced for there to be less volatility in gold assets than what we have seen. We've seen 17%. They're expecting 16% going forward. Doesn't seem like a major change, but it's a decent amount when you think about 1% on something that's only at 17 total. 1% divided by the 17 number is 5.8. So it's priced about 6% lower than what it's actually realized. That's not insignificant. Meaning if you were to multiply this by 4 to make it a number similar to Zoom, so imagine that this were at 68, well, that would be 16 times 4. That would be at 64. So it would be 4% lower than the historical. It's not a major difference, but I'm just pointing out that on a percentage basis, it's still a little different there. If we look at the S&P again, just live in the markets, notice they're expecting a lot less volatility than what we have experienced. Options are priced in SPY for 19% volatility going forward, and the actual volatility we've seen has been in the neighborhood of 22%. So do with that what you will. You can clearly see that the options are pricing in less than what we've seen. If you think that's underpriced, well, there's a trade to take advantage of that. If you think it's fairly priced, well, then it's kind of a non-event. You do what you will with it. If you think it's still overpriced and we're going to experience even less than the 19, then you'd want to be an option seller and bet on it. Maybe we only experience 16%. If we experience 16, then that is overpriced. So it gives you some idea of kind of how to look at this and use that historical versus implied number. Finally, last but not least, market volatility, the force that affects all symbols. In today's markets, again, there's just a lot of algorithms, computerized trading. This tends to create volatility intraday. Now, this isn't necessarily something that's long term. This money doesn't stay in the market for long extended periods, but those little short bursts can definitely move stocks intraday. So asset allocation models, rebalancing, all of that plays a role in how assets move. Market volatility is the velocity of price changes for any market. This includes commodities or forex or stocks. So if you're looking at, a certain market, there would be a type of volatility that you're seeing. If there was a major change, like take forex for example, that is its own market, right? So if the Federal Reserve or, well, any central bank came out with some huge announcement, that could really impact maybe all assets, but definitely the currencies of those countries. Increased volatility of the stock market is usually a sign of major tops and bottoms. When you think about volatility bursts, usually stocks will kind of, if they finish their uptrend, they do so in dramatic fashion most often. It's kind of like there's this huge explosive move that puts the finishing touches. So a market top would very often look that way. Stock market bottoms often have huge volatility. Again, collapsing type of prices, people just throwing their hands up in the air and just giving up and saying, I'll never own a stock again. That type of bad news and that huge volatile reaction is very common at stock market bottoms. So the volatility index is a gauge of volatility for stocks, and they often call it the fear gauge. When the VIX is high, it tells you that stock prices are usually falling, so stocks go down when the VIX is going up. There's usually that inverse relationship, and fear tends to get more fear, right? There tends to be follow on. So fear is an interesting thing. It plays out over time, and the more fear creeps in, the more fear it brings beside it. It's kind of like, if we all panic, anyone within the area will start to panic as well. They'll just see the reactions and say, well, if they're fearful, maybe I should be fearful, And so people open up their statements, they turn on CNBC. If everyone is talking sour and, oh, I can't believe how big stocks are falling, it's going to drive more fear in the marketplace, right? And so the VIX does a good job of just kind of gauging that fear and that volatility. So here's the VIX, and you can see the inverse type of relationships that when the VIX spikes up, like it did here in late August, early September, or here in late October, see those two big spikes up in volatility. What do you think stocks were doing? Well, if I click to the next chart, of course, they typically have the inverse relationship, right? So you had big volatility events corresponding with some of those reactions. Usually, again, kind of an inverse relationship where stocks move opposite to the volatility index. Now, when we think about the VIX, you kind of want to think about this in context of what's normal and what's abnormal. So, to put the VIX into perspective, it spends more of its time, like a 17 VIX would be about market and not average. Averages get skewed on the VIX because the VIX has only gone into the single digits, but it's been as high as 90. So if you were taking the average VIX, it would throw up a much higher number. You kind of have to think about difference between median and mean. But if you think about kind of just where it spends most of its time, this is kind of the area. Around 17 VIX is historically where it spends a lot of its time. Now, does that mean it just stays at 17? Of course not. But if you just kind of say, well, it spends a lot of time at 19, 18, 17, 16, 15, 14, just kind of in that zone, that's a more normal VIX. Anything well below that, we've had periods where we've dipped into to a 9 VIX or an 8 VIX. Well, that's exceedingly low. That just tells you that, there's a lot of complacency, a lot of stocks are just not moving, and it's just kind of this slow market that's just going to the upside, but nothing's happening whatsoever. When the VIX is higher, and specifically, anything above 30 is pretty abnormal. You don't spend a lot of time normally up above 30, up in that area. Those are a little more rare that you get those spikes. Now, on occasion, you get a spike above 30 that stays there and it keeps going 40, 50, 60, 70, 80. We've had 2 events that have driven the VIX to 80 in the last, 30 years, let's call it. In the last 30, 40 years, you had the financial crisis in 2008. The VIX got as high as 90. And you had COVID. In March, it got as high as 80. Those were abnormalities and obviously massive, massive reactions in stocks, right? So in 2020, we had one in 2008. Are those events more frequent? Or is this just, kind of a rare 20-year period where we had a couple of those? I don't know the answer to that. Maybe with all the Fed involvement, more capital, more money printing, I suppose that should theoretically drive more volatility and not less. But you can see the VIX, for the better part of 2020, we've stayed at high, high VIX numbers. Now, you're kind of getting back here closer to normal. And what you'll kind of find with the VIX is it has long, long periods of downward grind. And then it has these short, steep spikes upward. Usually the spikes upward are not long lasting. They kind of fade off rather quickly, and then you start to go back into a lower grind. So the VIX spends more time going down than up. But when it decides to go up, it typically goes up in more dramatic fashion. So they're just kind of that different relationship. And it's kind of inverse to stocks, where stocks spend more time going up, but when they decide to go down, they go down in dramatic fashion, and they don't stay down for that long, historically speaking. If you think about average duration of a bull market is like 6 years, average duration of a bear market is 1 or 2. Stocks don't stay down for long, long periods, historically speaking, but they do have those big flash drops that are, dramatic, and they're awe-inspiring. They are crazy when you're in one of those, and it just has a different feel to how the markets are. So we've talked about 5 different types of volatility, how to kind of wrap your arms around that. Volatility is not something to be afraid of. As traders, we kind of embrace it, but we want to be prepared and kind of understand what's happening between asset classes, what the flow of that is, what different volatility readings might mean, and start to learn how to kind of gauge volatility, get a sense of whether things are going to move more or less than expected. These things will go in trends. So when volatility starts to spike, it tends to drive a little more volatility and a little more, and then it kind of gets carried away. So there's these cycles that it goes through, and you'll learn that over time and with some experience. So hope you've enjoyed this class on the 5 types of volatility. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.